All right, welcome to the Legacy Wealth Podcast, where we teach accredited business owners how to invest in anything that's not the stock market, i.e., alternative asset funds managed by professional managers. And today we have on the show Natty Zola, who I used to previously work with at Techstars. Natty was my managing director when I went through the Techstars Accelerator program when I had my startup. And then we have my co-host, Mike Klein, who's a fellow GP or general partner. He runs his own fund at Crypto Bull Capital, which is a crypto fund. Mm-hmm. And just welcome to the show. Thank you.
Yeah, thank you for having me.
And I actually sat on a board with Natty.
Yep.
So we're close.
We have a lot of history together, which is great.
What board?
Ave.
Yeah, that's right. Yeah,
my fellow classmate.
That's right. Yeah. In the Techstars program. Yeah. So it's really cool.
Yep. Okay. Well, cool. So to kick us off, Natty, this show is all about funds. Tell us about specifically venture capital. Why should we, if we're looking at all different types of funds, whether it's real estate or oil and gas, or I don't know, last week I was talking to someone who invested in pharmaceutical funds. Tell us why we should be in venture capital.
Great. Well, venture capital is a pretty broad asset class, so maybe I'll narrow it a little bit here. And the part that I'm really familiar with is software-based venture capital, where you're investing in software companies, anything from the earliest stage. So it could be a guy and a gal in a garage with an idea on a napkin up to a scaling business like a company like Stripe, which is still a private company and it has attracted late stage rounds of venture capital. So that phase of venture capital is, a relatively large asset class now and covers a wide gamut. Why investors should be interested in it is, if you look back, and I don't have this data on me, but I think of the last 15 years, the top performing asset in many of those years, more than any other asset class, is actually venture capital. So I don't know the exact number on it, but I think it's sort of averaged north of a 15% IRR. Some years it's been as high as 30%. So it's actually been one of the top performing asset classes over the last 15 years. And that's really driven by a few factors, but the rise of technology, software sort of eating the world. And we see that trend continuing. And I'm sure we'll get to that a little bit more. But if you just look at pure returns, it's been one of the top performing asset classes. And if you want to build a diversified mix across different assets, it provides sort of a unique way to increase returns and work across a longer duration that I think appeals to a lot of investors.
Yeah. What's like the typical type of investor that maybe you've interacted with that invests in funds like yours or Techstars or,
Yep. I think there's sort of like two main groups. So there's institutional investors. So this might be pension funds, endowments, large family offices, where they're really a sophisticated investor investing across many asset classes. And most of them allocate some portion of their capital to alternatives or private equity. And then a piece of that is venture capital. It tends to be a smaller piece. So maybe in the, call it 2 to 10% range. So it's not the main asset, but it is certainly a bucket that there's consistent capital going into. And then the other side are individuals. So we, like in our fund and many peer funds, we have a lot of either high net worth individuals or accredited investors who are excited to invest in venture capital funds, not only for the returns, but they also get to be on the cutting edge of technology and the future. And so instead of investing in sort of like legacy businesses, you're really investing in what is the future going to look like, and being part of that. And so we see a lot of individuals who get excited about investing in venture because they get to kind of like look around the corner, play a part of the future. And like I said, it's performed well as an asset. And so those are kind of the two big buckets. And then I would say maybe the middle bucket is family offices. So you have, smaller family offices who are trying to build sort of a diverse portfolio, and it becomes part of their mix, to larger family offices that have really sort of like act like institutional investors.
And talk to us a little bit about how that investment works. So we have liquid funds, right, that really focus on cash generation on the show. And then we also have funds that really focus on building wealth. And that's the primary focus of those funds. Talk to us a little about venture. What are the nuances there? What's the experience of an LP over the life of a fund? How long is a fund? All that good stuff.
Yeah. So venture is unique in the sense that it is not optimized for cash flow.
Right.
It's optimized for a big, the goal is you give a fund like mine a bag of money, and our goal is to return a much bigger bag of money over the next 10 years. But it is not designed to generate consistent cash flow. It's really designed to build a multiple on the initial investment over a longer period of time. So I think that's important for potential investors to know, because what ends up happening is, as a limited partner, you give the general partner a commitment. They call that capital over 2 or 3 years as they invest that into startups, but you're not going to see that capital back for 7 to 12 years. The average venture fund lasts 10 years. And so really the expectation from an LP should be anywhere north of a 3x return over that time period. The cool thing about venture is you're sort of have an uncapped upside. So it's very hard in other asset classes to have a 10x return or a 50x return or a 100x return. And while that's super rare in venture, it can happen across a fund. And I'm friends with a few fund managers who have delivered over 100x returns on their funds. And so the upside case in venture is very appealing. And if you invest in a good manager, I think your downside is also limited. And it should perform as well as sort of a public equity portfolio on the downside, but you really have sort of uncapped upside, which I think is exciting. But you do tie up your cash, and so it is an illiquid asset, and that makes it really LPs need to think about how does this fit in their mix of assets, because you're not getting a constant stream of cash flow from it.
Yeah, and let's talk about that a little bit. So, I mean, I have a background in venture capital, and some of the things that I experienced, it was pretty funny. After I'd been in the profession for a while, were these kind of nuances that you take for granted. For instance, I remember talking to LPs, and there's be like this epiphany moment where they said, "Oh my gosh, like you're saying, like if I'm putting $100,000 into your fund, you don't just call $100,000 at once. Like you said, it's called over 2 years in increments." And then the same on the exit side, right? Like it's not just one big exit at the end of the rainbow. You're getting exits along the way.
Yeah, so this is sort of different from other things, and I think worth digging into. So let's say hypothetically you make $100,000 investment into a venture fund. What typically will happen is they won't take that money up front. At some point, they'll sort of like close the fund,
Right.
and then they'll start calling capital. And what typically happens is that capital is called over 3 to 4 years, and it depends how the GP manages it, but let's just say for sake of ease, they're going to call capital twice a year. So, and they're going to call capital over 4 years. So there's basically 8 capital calls over the first 4 years where they're going to be taking 1/8 of your commitment at a time and investing it over that next 6 months into companies. Then what typically happens is from sort of end of year 4 until some of those companies start exiting, there's really no flow of capital. Maybe, a small flow of capital for fees and stuff like that, which we can talk about. But really it's like over 4 years, you're sort of slowly calling capital. And then towards the tail end of the fund, as companies start to exit, that capital starts getting returned and hopefully multiples on that capital. But there's an interesting sort of mismatch in terms of when the capital is called and when the capital is returned. That is some ways a feature and some ways a bug. Like the feature of it is you can't really do anything else with that capital once it's committed. So it doesn't really allow you to sort of like be swapping in and out of assets. Like you're committed and you are there for the ride of those companies. And for some investors, they love that because they don't have the overhead of thinking about like, should I move this across assets and stuff like that. And I know a lot of investors who are excited that, hey, I park my capital with you. I know I'm going to hopefully see a big return in 10 years. I can't really do much around it. And so for some people, that's a feature. For some people, that's a bug because they want to be able to like maneuver their capital around and shift it between asset classes. And you just really can't do that with venture. So that's the typical flow of funds.
Yeah. I think it's super helpful.
So when you're investing in startups, give me an example of a fund or an example investment where you 100x. I'm thinking maybe,
Yeah, cool. So we have multiple companies in our fund that we've been lucky to invest in from the earliest stages and then see them really scale. So I'll give like 2 examples of companies that we got to know very early when they were like, so a company here in Denver, it was basically like 2 women who had this great idea, and we invested in them basically at the idea stage. That company, we made our initial investment, I think at around a $4 million valuation is what the company was worth. That company is now worth well north of $200 million. And so, here you have a 50x return on a company already that's scale that I think has barely scratched the surface of what they could do as a company. And so we expect that company to become, hopefully worth well over $1 billion. And so there you go from a 50x to, hopefully like a 200x return. And that's just one position of 35 investments that we, at least at Matchstick, make per fund. Obviously that's an outlier, and hopefully we get multiple of those in a fund. And that's where you have a really top performing fund. But there are going to be startups in the portfolio that don't do well and do fail. And I think from a venture investor perspective, we kind of look at it as a third of our companies are going to fail, and that's fine, right? Hopefully we back the right entrepreneurs. They work their tail off. Maybe the market didn't materialize. Like, who knows, right? That just happens. About a third of the companies are going to return about what we invested, a 1x return on capital. And that might be a combination of some companies that double the value, some that half the value, but there's we kind of get our money back. And then you have a third that really are the outlier performers. And the hope is in those outlier performers, you have some real outliers, some 10x to 100x to 200x returns that really drive the returns for the fund. And, that's what we're really trying to find as venture investors are these sort of like power law distribution in returns within a fund.
So it's really, as a prospective LP in a fund like yours, I shouldn't be scared or think you're a terrible manager if like a third or even half of the companies fail. Like, that is to be expected. And then you have 1, 2, or, if you really nail it, like 3, 4, 5 companies that blow it out of the water, and maybe you invested $50K and that could turn into, I don't know, either $150K or could turn into $1 million or turn into, right.
Yeah. And I think that's sort of, it's a unique thing about the asset class. Cause like usually when we think about investing, like failure is not an option, right? Like we don't put money in public equities expecting that company to go to zero. But in our world, we should, like, if we're making the right investments and taking the right amount of risk, we don't want companies to fail, but if our companies aren't failing, we aren't taking enough risk.
Right.
And so what we really get paid to do as venture investors is to be very thoughtful about where's technology going? What are the technology trends that could be really big over a 10-year period, and make really smart bets in companies that would capitalize on those secular trends or macro trends that are happening. And some of those trends don't end up materializing. And so those companies fail. Some of those trends end up being smaller than we expected. And that's kind of where you get your money back. But some of those trends end up being huge. And when you catch a company that really is able to like have a great management team, catches a trend, I mean, the upside is sort of uncapped on what you can earn as an investor and the impact that company can have. And that's a really fun part about being an investor in venture funds is like you get to go along that roller coaster and see all of that stuff. Where if you're investing, real estate's not really going to do that. Like public equities are not going to do that. And so that's why, frankly, a lot of investors are excited about venture.
Yeah. Let's talk a little bit about stages, because I think that's really important, right? So talk us through like the different stages of venture, how that works, and then what different stage venture funds, what they're going to look for in the profile of the companies that they're targeting.
Yeah, it's a great point. So we at Matchstick, we are a seed fund. So we're investing at the earliest stages. So this is like a guy and a gal in a garage with an idea up to $1 million in revenue. So this is when a company is probably at its riskiest point. But we get compensated for that because if the company really works, we invested at a much lower valuation. And so we get the benefit of all of that compounding value and upside. Above us are Series A investors. So these are investors who are taking on less of the sort of like product and team risk that maybe a seed investor is taking on, but the company is still early. So these are investors who are typically investing when a company hits about $1 million or $2 million in revenue. And their goal is, let's get this company sort of to the $10 million range. And those are bigger investments. There are fewer of those because not many companies sort of get to that stage. And then you go on from there. So you have Series B, Series C, Series D, which is sort of like each layer of growth for a company, call it from 10 million to 30 million in revenue, 30 million to 100 million. And then you start to get to like the pre-IPO and later stage venture funds. And so there are specific skill sets and specific values that different VC funds deliver across that stack. And for entrepreneurs, they really want to find like who's the right partner at each of those stages, who has a ton of experience getting a company through that phase and then to the next phase and has a network with those investors to kind of help that company go across that journey towards eventual, big exit or IPO. And so that's sort of like how the process works is companies sort of graduate from seed to Series A to Series B, Series C, and whatever rounds they need before ultimately exiting or going public is the goal. Obviously, not every company makes it through that whole phase, but hopefully, we're all at least on the same trajectory of trying to do that.
Yeah.
Why do you focus on seed stage versus, let me ask that question differently. Prospective LP.
Mhm.
Why would I, and I've decided, look, venture capital, something I'm interested in, I want to place money here. How do I choose between a seed fund and a Series C fund?
Yep.
Yeah.
So it depends sort of on the risk tolerance that you want, and also maybe what's interesting to you, um, and what return profile. So let's go through those. So first is, or maybe I'll start with what's interesting to you. So investing in sort of a later stage fund, those funds typically are much bigger because you have to deploy more capital. Like instead of us we write $1 million check into a seed company, they're going to write a $30 million check. So they really can only do a few of those, or maybe even $100 million check. Like it kind of depends. So what you're investing in there is sort of a more secure business that's more established, but your upside and potential return on your investment is lower because that company is raising at a significant valuation. And so, you can't go from maybe you're raising at a $500 million valuation for that company. If you 4X it, that's a $2 billion company. There are not that many $2 billion companies out there. Like that is a big company at that point. So you're having less risk, but you have also less upside. If you flip to the earlier side, like where I'm investing, we're going to have more companies fail. We're going to have, more companies in our portfolio. So you get to see a lot more companies. You get to be at the like earliest stages where you're going from 0 to 1, which some investors just really prefer because they think that's more interesting than sort of that like, later stage where it's really around optimizing the model. But at the earlier stage, you have more potential for outlier returns because we are aiming for taking a company from, say, a $5 million valuation to a $500 million valuation. That's a 100x return for us, which is going to return our fund and generate great returns for our portfolio, where you cannot really go 100x from 500 million. Well, there are a few exceptions out there, of course. And if you get in those companies, like, it's fantastic returns. But yeah, so it kind of had like is a combination of what are you interested in working, or what like stage of company is interesting to you? What return profile do you want to have? Do you want to have a little bit more certainty but lower returns, or do you want to have a little less certainty but higher returns? Um, and yeah, I think those are sort of like, I guess the other thing is access. So one problem is a lot of these later stage funds, it's hard for an individual investor to get access to the top quality ones because they tend to require like pretty big minimum investments since their funds tend to be bigger. And so I think it's a little bit harder for like the individual accredited investor to do those later stage funds. Although there is a bunch of innovation happening there around special purpose vehicles, angel list stuff that can sort of aggregate a bunch of smaller checks into these later rounds. Like a friend here in Colorado is doing that I think is very interesting, but that's sort of been a harder asset class for people to access just due to the size of numbers. On the earlier side of things, we work with small investors, $50,000 commitments. And so there's a lot more access to that type of fund for the individual investor as well.
And then there's not just stages when you think about the type of fund, but also industries. Talk to us about
geography.
Yeah. Talk to us about all the
Yep.
different types of funds.
Yeah, so you've seen this huge proliferation of VC funds. So I don't have the exact stats on me, but like venture capital as an asset class has grown a lot in the last 4 or 5 years, and we've ridden like a pretty significant bubble, which we can talk about at some point. But I think the macro trend of technology not slowing down, innovation not slowing down, software being applicable in more and more industries is there for the long term. So long term venture is a very solid, very like prevalent and growing asset class, even though we may see a little bit of a downtick just because of the run up for the last little while here. But every VC fund sort of should have a strategy. Are they focused on a certain industry that they know super well? Are they focused on a business model that they know really well? Are they focused on a geography where they have unique access to startups? And so I think if you're underwriting a venture fund, you want to really believe in whatever strategy they have and feel like the GPs are uniquely qualified to execute on that strategy. So you'll come across funds that are only investing in AI companies. And that's great, right? The underlying thesis for that fund is AI is going to be a bigger part of the future. There's going to be great businesses built around that. And they are gearing their whole fund strategy around attracting the best AI startups and then investing in the ones that really stand out to them. And I think that's fantastic because they're experts and they should be able to attract really good investment opportunities. You You might have a venture fund that only invests in marketplace businesses. So maybe they're generic across, they don't really care about what segment they're serving, but they only want to invest in marketplaces because they know that business model super well. Maybe they ran a big marketplace business. Maybe there's something in their history that makes them uniquely suited to do well in that business. I think, that's really good to look for. Or you might have a geography. So I'll use Matchstick as an example. We're investing in what we call underserved but rapidly growing geographies, mostly the Rockies, Colorado, Utah, or the north regions of the US, Illinois, Wisconsin, Michigan, Minnesota, Indiana, Ohio, where we see there are great entrepreneurs, but they don't have the same access to capital. And for us, for a fund strategy, that gives us good deal flow or great deal flow that other people aren't getting or aren't looking at. And that enables us to win good deals at good prices. And so if you're a potential LP, I think you just want to have a really, really good confidence around what is the strategy that this GP is putting out there? Are they uniquely suited to capture that strategy? And for you, does that strategy hold water? Like, do you believe that AI is going to be as big as it potentially is? Do you believe in marketplace businesses and there being a bunch of potential for that? Do you believe in investing in companies off the coast in these other geographies? And if you don't invest in that fund. But I do think every VC fund should have a pretty distinct strategy that plays to their strengths.
So I think there's actually a natural, really cool progression there. So when you're putting your LP hat on, maybe a better way to say is when an LP is sitting across from you, what are the questions that you wish they would ask you? What are the best questions to ask the managing team of a venture fund as you're assessing, do you want to invest in that team?
Yep. I kind of like harken it back to like Jim Collins, who I used to work for. There's sort of like his hedgehog concept, which is like the union of these three circles that I've sort of like changed for this question. One is, what can that GP be the best in the world at? Mm-hmm. Like, do they know something super well, like an industry? Do they have access to startups in a unique way? And so like, what is sort of special about that GP that is a competitive advantage for them? Two is, how does that competitive advantage show up in their model? So is there a way that if they execute on this strategy that they are the best in the world at, it can generate significant returns? And so that would be like in some of the examples we've talked about. Okay, what AI startups do they have access to? At what price are they investing in them at? And what is the exit potential for those companies? So sort of does the like unique strategy of that GP actually have like a sound business chance of working if they execute on it? And then I would say the third one is like you want to find the GPs that are obsessed with it. Like, it is not an easy business. These funds take 10 years. You're hand-to-hand combat with the entrepreneur. That sounds bad in the sense that you're not competing with them, but you're like, hopefully you're sitting next to them in the trenches, helping them figure stuff out. You're going through that roller coaster with them. So it is a very slow way to maybe get rich. So you got to find the GPs that really love it and it's their mission, because otherwise there's just, I would say, like easier, quicker ways to, possibly get rich. So you really want the ones that like, for them, this is their like true passion or calling. And so I would want them, the LP, to ask questions to kind of get clarity around those three things.
Yeah. I mean, you bring up a really good point, right? Is like a lot of people, they think of just private equity and they lump venture capital in there. But to me, like, general private equity, you often are taking majority ownership in a company. You have control. You're maybe injecting your own management team. Where in venture, you really have to play nice with the entrepreneur and you have to be a trusted source of wisdom, because you don't have that, right? Like, talk a little bit about that, but you don't own like 50% of the company. You don't have majority on the board. Like, you're really betting on the team that exists.
Yeah. I think you captured it super well. I mean, that's the unique thing here is like, what we need to be really good at, certainly on the early stage, is like finding the teams for whom this is like their life's work. It can't not work for them. And they are, as obsessed with it as we are about working with them. And so you really are backing a team. And your job as a VC is to build a trusted relationship with them so that you have influence at the time when it matters most, and that those entrepreneurs come to you when they need help. And if you don't build a trusting relationship, they're not going to come to you when they need help. And therefore you can't sort of help work on the value of that business that you've invested in. Where in private equity, you're kind of taking over, you're putting your team in charge, you have more control. And so the beauty of the venture model is you're finding the best and the brightest who are better than you are at operating that company and giving them the resources to go do that. And that, can make that can be bigger than something that you could run yourself. But the downside is you don't control it.
Right.
And so that's like this unique balance that VCs have, where it's like you need to build a trusted relationship so that you have influence, but you aren't the one in the driver's seat. Which, sometimes can be frustrating because you want to tell an entrepreneur to go left, but they need to like figure that out on their own.
Right.
But you're still at the table there trying to influence it. And I think that's honestly one of the fun parts too, is you just get to like kind of be a part of someone else's journey and be a supporter for it. And really like see them grow into that role of CEO and building hopefully a world-class company.
So let's shift to talk a little bit about all the things that you do as a VC, because I think a lot of LPs think, oh, I want to invest in startups and I can do this myself. And maybe you can, but I find that usually that statement is made with the absence of knowledge of all the things that are required to do it as well as a professional. So let's talk a little bit about that. What does your day look like? What are your responsibilities? How many deals do you guys look at a year?
Yep.
Break that down.
Cool. Well, I think there's sort of like 4 key phases in a VC's existence. So the first is fundraising. So just like a startup needs to go raise money, we as a fund need to go raise money, which is kind of the point of this whole podcast. But we go out and we build relationships with both individuals and institutions and sort of like pitch our fund strategy in hopes of raising a fund. And then, that takes a lot of work. For our first fund, it took us 18 months to raise our first fund. Our second fund took about 12 months and our third fund took about 8 months. So I think we're getting better at it, but we have more track record and more relationships, but that's a lot of work to raise a fund. So let's assume you go out and you're able to raise a fund. The second thing you need to do is attract startups. So we call that sourcing. And I think this is actually the most important part of venture capital is you need to make sure that you are getting in the mix with the best deals within whatever your strategy is. So if you're an AI focused fund, like how are you making sure that the best AI startups know about you and you get to at least, have them pitch you, build a relationship to see if you want to invest. If you're a regional fund, how do you make sure that all the local startups are coming to you? If you're a marketplace fund or whatever it is, like how are those businesses, do they know about you? And so we as VCs need to spend a lot of time building our network and our brand and our reputation to make sure that the best startups are both finding us, but also we need to spend a lot of work. And this has been a big shift in the venture industry where historically startups came to VCs. Now it's shifted and so competitive. VCs are outreaching to startups and we've set up, and I know a lot of VC funds as well have set up all these trackers to figure out like who's starting companies and what, and basically doing outbound marketing. So sourcing is, I would call it 30% of our time. Outside, let's assume we fundraised. So now we have a fund. I would say sourcing is about 30% of our time. Then there's selecting. So sourcing is like kind of top of funnel, making sure you're meeting with a ton of entrepreneurs. We're meeting with probably 20 to 25 companies a week. And that's sort of like top of funnel. Then it's like, which ones are getting through that funnel that we get really excited about? And how do we choose sort of the best of the ones that have stood out? And for us, that's about one investment a month. But we're investing in less than 1% of the company. So you have to meet a lot and then sort of like figure out what's your process for actually making an investment. And then the fifth one we call scaling, which is working with the entrepreneurs that you've now invested in.
Mm-hmm.
So it's really important as a VC, at least from our viewpoint. It's not that you just give this entrepreneur $1 million and you say, hey, see you in 10 years, hopefully. It's how are we supporting that entrepreneur? So what is the cadence of working with them? And that could be as much as weekly meetings. It could be, maybe as infrequent as quarterly board meetings. From our perspective, we're super hands-on with the companies we work with. So we're in constant communication, helping them connect with talent, helping them meet customers, helping them solve problems. So you're very active day to day. And I would say from our perspective, let's call sourcing 30%, selecting 15%. About 50% of our time is working with the portfolio companies that we've already invested in to make sure that those companies have the best shot at being successful. Kind of the last 5% for us is like operations, which is the day-to-day of running a venture fund, which is actually surprisingly a lot of work, but audit, tax, accounting, data, and that sort of stuff. So I would say like those are the buckets. An average day for me is probably meeting 5+ new startups that I got connected with and kind of getting to know them. It's spending a lot of time with my partner and our team deciding which companies do we want to advance through our pipeline. It's spending a lot of time with our portfolio companies just to make sure that they have the resources they need to be successful. And then, around that, managing an inbox with, 300 emails a day, plus, tax, audit, accounting, operations, managing
Every
our team
entrepreneur
as well.
emailing
So,
you saying, hey, do you know
yeah.
this customer? Can you make an intro? You
I mean,
So not a lot of work, not a lot of work at all.
Right. I feel like I have the second best job in the world. The best job in the world is being an entrepreneur on the mission of something that you are obsessed with. The second best job in the world is mine, because I get to enable those folks and kind of be a small part on their journey. They have a harder job than I do, the entrepreneurs, but like, at least from my perspective, like we work our ass off to like, make sure we're delivering value to our customers, which are our startups, but also to our investors, because, we're stewards of their capital.
Let's talk a little bit about like all the ways that you get deal flow, because I think that's important.
Yep.
and how many deals you're looking at, like,
You said it's 25 a week.
Yeah, but like
that's
in
the
a
number
year.
we're meeting with. So like we'll look at about 3,000 to 5,000 startups a year for our fund.
Wow,
Like,
We'll
think
invest in
about
about
that.
12.
That's a lot of companies
Yeah.
It's a
to
lot,
look
yeah.
at, and you have to know what you're looking at, and you have to assess. Is this guy blowing smoke? Is this?
Well, and here's the challenge. Like, I mean, a unique opportunity and challenge for us at the earliest stage is, if you're a late stage investor, first of all, there's not 5,000 startups to look at a year that get to like Series B or Series C.
Right.
And also, if you're a Series B or C, you have a lot of data. Like, you have years of revenue data, probably. You have like years of cohort analysis around how the startup's users are engaging with the product. On our side as a seed fund, this might just be the track record of the entrepreneurs prior. This might be just the caliber of their idea. And so really, we're investing in a team and a dream. And so the only way that I think that you can really diligence that is by spending time with the prospective, companies and founders you might invest in. And so that's the part that doesn't really scale. That's a challenge. But yeah, we'll look at 3,000 to 5,000 startups a year. We'll probably meet with about 20 to 25 a week. And that will eventually lead to about 10 to 12 investments per year.
Yeah. And early stage is a lot more, I feel like, collaborative, in the sense of like, you guys, I think this is an important point. You guys aren't necessarily taking the whole round. Like,
Right.
you're not objective. Your objective, which for a lot of later stage funds is like, we want to write the only check, preferably, and the biggest check. Maybe we have one other partner that we let in there. Where I think also a big part of your job is, especially if you're leading a round, is you have to manage these other investors, right? You have to answer their questions on the due diligence, and you have to kind of like corral the cattle and everybody, okay, let's get in this thing. And like, okay, these are the terms and all that good stuff.
Well, this is, I think, one of my favorite parts about this job is we get to work with other investors to support the companies.
Yeah.
And typically we have been the only investor in a round for a company, but more often than not, we collaborate with other folks that we trust. And that's a fun part, is like teaming up. Like, we've teamed up on deals
super
before,
fun.
like we've like worked on deals before. And so that's a really fun thing, especially with the investors that you know and trust. So we're very collaborative. We like working with other investors, and our fund size and check size is not so big that we can't collaborate. And that's on purpose, because we are a very collaborative firm.
Yeah, I found that to be, I've done late stage and early stage, and that's what I really enjoyed about early stage, right? It's much more like you said, they're pursuing a dream, you're supporting them, you're all on the same team, you're going to add other people to the team. It feels really good.
It does.
Yeah.
So putting my LP hat on, I get a ton of work, right? You're looking at tons of companies, you're getting tons of emails in, you need to set up meetings, you talk to them. Are you meeting with them for half an hour? What kind of questions are you asking them? Like, in my mind, or I mean, I know the amount of work that goes into this, but for the audience, it's like, are you asking like, hey, how's your day going? What is the food? Like, someone could think oh, he's just talking to the entrepreneur and he like kind of gets.
Maybe let's do like let's do like an example company, like company X.
Yeah.
Right. So you find out about company X. We'll make up how, and then through you invest, and then we get a big exit.
Cool. So I'll tell you what we're thinking from a venture perspective when we meet with a company, and then we can I can role play some questions we might ask. So this is actually something I learned at Techstars, and it's really carried over to our fund, is how we look at things. Is we look at 6 things in rank order, and it's team, market, progress, idea.
Do you look at
and
team?
It's sort of like a cheeky reminder for us that at the stage we're investing, largely it's all about the team and the market, and really the existing progress or the idea doesn't matter. And in my experience, the ideas of these companies at this stage morph so much that if you get obsessed with the idea, you're going to be disappointed, because that may not be the idea that works. So you have to get super excited about is the team. and the market that they're going into. So we spend the vast majority of our time understanding the background of the team. Why did they choose this idea? Why are they uniquely suited to capitalize on this opportunity? What's their sort of earned insight around why they think there's an opportunity in this market? What's novel about what they're doing? Those kind of areas is where we spend a lot of time. And so, yeah, it's really just about like getting to know people, understanding their background, understanding their motivations. And there's sort of no shortcut. I mean, we've developed some questions that I think help us get to the answers somewhat quicker, but these are sort of longer conversations. But to an earlier question, what we end up doing is like we kind of do quick 20 to 30-minute meetings with lots of startups, because what I have been able to hone, and I've been doing this now for 7 years, and so I've probably met with 20 or 30,000 startups or something. Like, it's probably insane at this point. I'm like pretty tuned now. Within 30 minutes, I can get a good sense. Like, is this the type of entrepreneur that I'm excited to work with? And sort of pattern matches for me, at least like the characteristics to build an outlier company. And is this a market opportunity that is novel, differentiated, big, et cetera? And so we end up doing a lot of 20 or 30-minute meetings with tons of companies just to like sort of find the diamonds that really stand out to us. And that doesn't mean all the other companies aren't going to be good companies, but the ones that just really appeal to us. And then sort of narrowing that down. And sometimes I share this sort of joke, which is I meet a lot of people who want to get into investing in startups, and maybe it's like, their nephew is starting a company, and so they're like, hey, should I invest in that company? And I'm like, I don't know if that's going to be successful. I think it's great to support your nephew in a company, but if you really want to do venture well, like, you need to see a ton of companies. Like, you need to see 1,000+ companies a year, I think, to get into the best companies and to do a good job of it. And so the challenge for most investors is, if you're not investing in a fund, you really have to do this full time to make sure you're seeing the best stuff and seeing a lot of it. And if you're not, like, outsource it to a manager who is doing it like, 60, 70 hours a week.
Yeah. And one of our theses here is that, most people would be better off focusing on the one thing they're really good at, because even if you choose to, okay, I want to put in the work, right? I want to follow the playbook. There's that learning curve. And like you said, you've met with 30,000 companies, right? And I actually think, like, I want to highlight your time at Techstars, because I think that also is really cool about your background and how it kind of parlays into your venture fund as well. So, like, let's talk a little bit about your time at Techstars.
Yeah, it's great. So I'll like zoom through a little bit more background. So I started as a founder, which I think has really helped me have empathy for the entrepreneurial journey and know what entrepreneurs are going through when, we're sitting next to them and we've invested and it's like a rough time. And I think that's helped us earn our way into a lot of deals too, because like we know what it's like.
Yeah.
But then after being an entrepreneur, I was lucky to actually went through the Techstars Accelerator as a founder. So I've had a lot of connection with that ecosystem, and it's given like an incredible amount to me. I usually joke that everything good that's happened in my entrepreneurial career has come from Techstars, which is, it's not even really a joke. It's pretty true. But I went through the program, so I was very familiar with what the benefits that it gave to entrepreneurs.
And just for the listeners, Natty, let's define what Techstars is. Yeah.
So Techstars is a startup accelerator, and the goal is surround about 10 startups with a intense 13-week period where they get to work very closely with tons of mentors to help them figure out and validate their business, and effectively make 2 years of progress in 13 weeks, and build a support network so that they can increase the odds of success for their company. Started in Boulder, just up the road from here, and it is now a worldwide phenomena, running 50+ accelerators a year around the world, backing, I think, well over 500 startups a year. And having gone through it, I know that it is an incredible experience and level up for the entrepreneurs and businesses that go through it. And then I was lucky to, after I sold my company, come back to the accelerator in Boulder, which I went through, and run it for 6 programs. That's actually where Pascal and I met.
I went through Natty's program. I was lucky enough to build a company that then Natty invested in, and that's how we got to know each other. So
yeah, it was, which is great. And so I ran that program from 2015 to 2020. And that was really a great experience for me, because it's where I learned how to invest, and it's where I learned how to be founder centric. It's where I learned, what matters to entrepreneurs at that early stage, and really get to practice that a ton. So I invested in 64 companies over what ended up being about 5.5 years, looked at, well north of probably 10 to 20,000 companies during that time. And so it gave me, as an investor, a ton of reps to both like test myself to see like, am I good at this? Do I love this? Is this what I want to do for the rest of my career? But also kind of build a reputation in the ecosystem and say like, hey, Natty's been giving back to this ecosystem. He's been doing this, for a long time, which gave me the foundation to then go and raise with my partner, Ryan, Matchstick Ventures, and really go kind of all in on the venture side of things. But that was a phenomenal experience to learn how to do venture, in my opinion, kind of like, the right way.
Yeah, that's really cool.
Yeah.
So now let's dive into maybe kind of transitioning over into your fund. Tell us about, there are tons of venture funds out there. Why Matchstick?
Cool. So let me describe Matchstick, and then I'll tell you why we like this thesis. So at Matchstick, we're investing in sort of like three core thesi. Is it thesis? Thesi?
However you want to say it.
The first is that we believe great entrepreneurs are everywhere. And so we have a geographic focus on investing in startups that are off the coast, and exclusively in the Rockies, which is mostly startups in Colorado and Utah, but also looking at Montana, Arizona, Wyoming, et cetera. And then across the north region of the US, which for us is mostly Wisconsin, Michigan, Minnesota, Illinois, Indiana, Ohio, and then the Toronto area. And the reason why we focused on those areas is it's sort of where we grew up as entrepreneurs and investors. So we have this big network, people know us, we have a reputation. And so we get to leverage that in terms of sourcing and driving startups towards us, which we talked about earlier, which is, I think, a really critical part of being a good investor. And so we really have like 15 years of track record in those two ecosystems. And so people know us, which is really important. The second is we've seen over the last 10 years that great entrepreneurs are everywhere and you can build a great startup anywhere. And the entrepreneurs in these markets have less access to capital. And so that's an opportunity for us to show up and be their first partner. And so the nice thing about that is there's less competition for us to get into deals, which if you're investing on the coast, it's pretty cutthroat and it's hard to get into the deals you want to get into. We really don't have that problem. We get into like 95% of the deals that we want, which is great. The second is the entrepreneurs are much more realistic around their valuations in these markets. And that is not that they're sacrificing their ambition, but on the coast, since there's so much capital there, the valuations end up like being much higher. And it really matters the entry price when you're determining your returns at the end of a fund. And so we feel like that there's a much fairer balance in these markets between the price that investors invest at and the equity that the entrepreneurs are selling. That is just like better for the whole ecosystem. And so that ends up showing up in our returns. So the main thing is this geographic focus. The second is we're only investing in pre-seed and seed stage companies. And why we focus on that is historically the best returning venture funds have been the ones that focused on the earliest stages. Like we talked about earlier, you just have much larger potential multiples on top of the companies because you're investing so early. It's also the phase of business building we know the best. Having done Techstars and run that accelerator program, I just like we both, and my partner has as well, we got a lot of reps in at that stage. So it's just what we know the best. I don't know getting from Series B to Series C that well, but I know how to get a company to $1 million in revenue, like probably as good as anyone, because I've just done it with 150 companies now.
Sure.
And then the third lens for us on the thesis is we only back software companies. And this is important because we believe that software companies have the fastest and largest potential of growth. It's the businesses that we started and know super well. And we just like the dynamics of how those businesses scale better than other businesses. And so Matchstick is we are now the most active investor in our core geographies, in many of the states in our core geographies. And so we're really well known as being one of the seed stage investors in these markets in software companies. And so we're just leaning into that strategy. And the good news is that strategy is working well. Our returns, at least on paper, because as we talked about, these funds take a long time to return capital, at least on paper are performing really well. We're very proud of the portfolio. And hopefully over time that will turn into actual returns to our investors. But yeah, I mean, it's somewhat of a differentiated strategy in the sense that not that many people are focusing on these geographies. We're happy to bet on teams super early, and we just believe a lot in software. So my pitch to prospective LPs is, if you believe innovation is happening in these markets, if you want to be a part of the next wave of the great companies in these regions, if you believe that software is going to continue to dramatically impact our world, and you want to be involved with companies from the earliest stages and see them grow, like we're a great place to put your money. And And I have this kind of like silly dream that I don't know if I've ever told anyone. So you guys might be the first, and your audience as well, is like my dream is that I live in Boulder, but we're here in Denver today, is I'm driving between Boulder and Denver, and whether it's downtown Denver or the buildings between Boulder and Denver, there's logos of companies on buildings that run great businesses, have fantastic cultures that people love to work for, that I had a small part in helping build, and really created a dynamic employment ecosystem in Colorado, in Utah, in the markets that we invest in. And I think we're on our way to that. But as you know, in venture, it takes a long time. So check in with me in 10 years and we'll see how many logos we have, dotting the skyline here.
I like it. That's a beautiful dream.
Yep.
Some follow-up questions around, you lead rounds, right?
Mm-hmm.
Why do you choose to lead rounds versus follow? So maybe distinguishing between the two. There are venture funds that don't lead. And then I'd love for you to maybe go into some more detail, because I've personally worked with you in this capacity, and I've had Natty literally coach me with my co-founders, from us potentially breaking up the company or raising more money and trying to figure out what to do. Like, maybe get into some examples of the midnight calls you take, and maybe the therapy that you provide, or the guidance, or the connections that were so impactful that you are doing for your portfolio.
Yeah, cool. Yeah, so leading and following. So a little background on that is, typically in a fundraising round, there's like a lead investor, and this is the person who's working most closely with the entrepreneur, setting the terms, negotiating the amount they're going to raise, the price of that of the equity, et cetera. And they tend to be the one that maybe takes the board seat if there's a board seat available. And so we're happy to lead. We actually don't lead all of the deals. We have decided that our mission is let's get conviction around an entrepreneur. Once we get conviction, we work with them. And if they need a lead, we're happy to lead. If they have another investor that we know and trust that wants to lead, we're happy to be a participant or follow on. We end up leading about half the deals that we do. And so what's helpful to the entrepreneur is when you have a lead, that tends to circle and galvanize a bunch more capital to come together, because hopefully someone of high integrity, conviction, reputation is committing to this company. It makes it more comfortable for other people to invest in it. And so we're happy to do that and be that signal to the market when we invest in a company. But we're also happy to join around that, as we talked about earlier, someone we trust is investing in, and we get to collaborate with them. Did that answer that?
Yeah, totally.
That question? Cool. And then in terms of the midnight phone calls and help like that, I mean, this is probably my favorite part of the job. Is I love when we're able to build a trusting relationship with a entrepreneur, and they call me at midnight. And actually, frankly, one of the questions that we ask ourselves before we make an investment is, we expect every entrepreneur is going to call us Friday at midnight, at least once, over the next 2 years. And are we excited to take that phone call? Are we happy to jump out of bed and go, pull up our laptop and spend 2 hours helping solve a problem? And if there's any tingling or spidey sense or, instinct that that's not going to be good, we pass on the deal, because that's the stuff we love. And that's, I think, the role that's important to take, certainly as an early stage partner with these entrepreneurs. And so, yeah, I mean, it literally is midnight phone calls trying to solve, an existential crisis. I mean, we just, who knows when this airs, but over the last week we had, Silicon Valley Bank had a bunch of stress, and, we'll see if it ends up failing or what ends up happening with it. But I spent 5 straight days on the phone from 5 a.m. till 9 p.m. with entrepreneurs, helping them figure out how do they access their funds if they're stuck at SVB, what are their alternatives, helping them set up new bank accounts, working with our investors to understand our exposure, building contingency plans with entrepreneurs, sharing information across our whole portfolio. And what a great opportunity for us to show up for our entrepreneurs and really help them. And it's stuff like that. Maybe it's the black swan out of nowhere thing. Maybe it's just, the entrepreneur. I had one of our portfolio founders call me yesterday who was in town, and he said, "Hey, I have this really challenging conversation with my board coming up. This is a company that's scaled beyond our stage. We were one of the first investors in it." And he calls me and he says, "I have this really challenging conversation with the board. Can I role play it with you?" And I moved my schedule around. We spent an hour and a half together in person, and he left that and then went off and crushed his board meeting and got everyone on the same page and got the outcome that he wanted. And, that's the fun stuff. That's super cool.
Yeah. And you guys want entrepreneurs that want that.
We want that. Yeah.
Yeah. If there's anything I know, you also look for entrepreneurs that are maybe coachable. Is that still the case? Talk to me about that.
Yeah, it's funny. I would say like earlier in my investor journey, I really optimized for coachability. I actually optimize a little less for it now. And we'll see how this plays out. I think that you need entrepreneurs that are willing, that are excited about feedback and data, but there's like sort of a spectrum here. So if you're too coachable, like you don't have strong enough opinions, so you're just sort of like blowing around in the wind. And if you're not coachable enough, you're unwilling to take data and evolve and like listen to and change your mind. And so I think the right spot is somewhere in the middle there, where it's the entrepreneur who's very excited about gathering data, but is sort of like brings a stubbornness, that is going to like push them to like really think about that from like a core first principles perspective. If it changes their strategy, they're open to that, but they're not just going to kind of get pushed around. So that's actually what we're looking for now, is the entrepreneur who like aggressively seeks out feedback, but is very like discerning in what feedback they take.
It's like, I think of the analogy, like you don't want somebody that just seems like they're, like you said, just a leaf in the wind, like they can change direction at any time. But you also don't want somebody that's like that scene in The Office where Michael Scott just like the GPS says go and he just drives into the lake, right? Like you don't want that either.
It's such a nuanced, it's such a nuanced like perspective. And so, but I do think like, if you're not willing to take feedback and like learn from the data, like you're screwed. So like that is super critical. And we are looking for that trait in entrepreneurs.
Are there venture funds or strategies or approaches that you see in the market today that you don't agree with? You don't need to name companies.
Or what makes a bad VC? Maybe that's a good question.
I think the bad VC is an easier one to answer, and let me see if I can like evolve that into like strategies that I don't think work. I think a bad VC is someone who doesn't realize that this is like a multi-move game, in the sense that they tend to optimize for the immediate transaction or the immediate situation and not think about that this is a business built on multiple opportunities to work with a small community, and that if you overly optimize for any given transaction, you are really shooting yourself in the foot for the long-term benefit of your LPs in your fund. And so I frequently see investors who optimize for one specific transaction, not realizing that they're really polluting their brand, ruining their reputation in, like I mentioned, like a relatively small ecosystem. Like venture is not that big. Like everyone is talking. And at the end of the day, really the only thing that you have to stand on as a VC is your reputation, both with other investors, with your LPs and founders. And so when you're overly transactional, I think that you end up eroding your opportunity in the long run.
So give us an example of that. I have an example of exactly that because I dealt with that at Techstars in my role. But
do you want to share your example? I mean, I'd be curious. Your
example. Yeah, I mean, my example would be we would get into so many situations where, so when you make an early stage investment, Techstars is usually one of the first checks into companies. In those agreements, you have pro rata rights. Pro rata rights mean that when the company comes around to raise capital the next time, that you have rights to maintain your ownership percentage. And so, if you invested $100K and then, the company grew 10x in valuation, you are now allowed to put in a minimum of $1 million in order to maintain that percentage. And there would be there would be a lot of other VCs that would come in and would try and push Techstars out of the deal. And there's a lot of dynamics at play where it's like, okay, like Techstars is a brand, we're there to support the entrepreneur. I've worked with you as well. And I think there's a lot of short-sightedness where it's like, you want to be working alongside the other investors. And I've even had, at one point, Natty moved on and started Matchstick, and we actually worked on deals together where, I was working on the follow-on fund, and I'd say like, we're going to make this investment in this company, and Natty already had a huge stake, and so we worked together, and he would, maybe we would get a little bit more of allocation, you would get a little less, but now we're both together and we're a team, and that's how I think like really successful VCs over a long period of time become really successful. And I thought was awesome about how you approached it, because it's a long-term game. You get this reputation amongst entrepreneurs that, man, this VC, is pushing me around. Like, when I raised money from VCs, it was very much, I talked to other founders. Would you have this VC on your cap table again? Like, how did they act on the board? Were they more of a teammate or coach, or were they the it's my way or the highway? And like, there are a lot of VCs that ruin companies.
Absolutely. Yep.
And so those are kind of the experiences.
Yeah. I have very similar experiences where, like, another example would be one of the terms in a term sheet is a liquidation preference, which effectively means, like, when the company sells, it guarantees that the investors get their money back, and then we share in the upside. And so what's most common is a 1x liquidation preference, which means, let's say $5 million was invested in a company, the company sells for 20 million. The first 5 million goes back to the investors to make them whole. And then we sort of like, and there's some nuance in this, but we share the remaining 15 million based on the cap table and the returns. And this is sort of like a very standard term and makes a lot of sense. What you sometimes see is an investor who says, I want a 3x liquidation preference, which would basically mean, in that scenario where a company sells for 20 million, but there was 5 million invested, the investors are going to get back 3 times the 5 million. So they get back the 15 million, the first 15 million, and then there's only 5 million to share with the cap table. So this sounds great as the investor. You're like, why wouldn't I have like the biggest liquidation preference I possibly can have? Because I'm sort of guaranteeing returns for me. The problem is, yes, if you're thinking about one turn and this company selling, like, that might be a effective strategy for increasing your returns as an investor, putting aside that it is certainly going to piss off the entrepreneurs because, they're the ones who did all the hard work and got, a fraction of the return. The problem is, you have now set a standard for the future investors. So let's say that company goes off and raises the next round, and those investors look at the terms of the prior round and they say, oh, wow, you got a 3x liquidation preference. We want that too. The problem is, the next investors have more seniority. So they now they're going to get 3 times their money back before you, as an investor in that prior round, get any of your money back. So you, in sort of the short-sighted nature of trying to optimize for that one situation, have really shot yourself in the foot, because if this company goes off and every round there's a 3x liquidation preference, you as the early investor are sitting below. There's an immense stack of capital that needs to get returned before you would get any return. And so, that's an example where people or investors optimize for like the near term for themselves, not thinking about what are the implications of this in a multi-turn game, especially when they're, everyone on the background is talking. VCs are talking to each other all the time. Founders are talking to each other, and reputation is like so critical in this business. Like, the moment that entrepreneurs don't want to work with you, you're basically dead. The moment that co-investors don't want to bring you into a deal or give you an allocation in a deal, like, you're dead. At that point, you really have adverse selection, and you are just looking at, the less appealing investment opportunities. And at that point, why even be in the game?
Yeah. Cool. Thank you for sharing. Yeah. I think, like, all of the, where does stuff go sideways, and how do you separate different managers, between if you're going to invest in them, understanding what style of VC do you resonate with? What's their process? How do they think? I think when you're thinking about investing in any kind of fund manager across any asset class, that's one of the most important pieces, if not the most important piece.
Yep.
Yeah. My experience has been, your venture is to be realized gains, right? And most people think of a transaction like, my job is to get the best deal possible, and then I get the reward of that right away. But the problem is if it doesn't feel like a win-win, then the entrepreneur is not going to even realize that. So it's like, great, you now own 60% of a company that nobody wants to work on.
Right. Or it's worth nothing.
Or so now it's worth nothing, because
the goal here is to grow the pie.
Right.
Like, the cool thing about venture is like, when venture really works, it's a combination of, majority of the entrepreneurs building a great company, building a great culture, a product people want in a new market, et cetera, with investors. And all of our goal is like, let's make the biggest pie possible. And yeah, sometimes maybe we have a slightly smaller piece than we intended, but like, if that pie is massive, we're going to do super well.
Right.
And I think that the more alignment there is with the investors and the founders, and stuff is sort of like simple, and we can spend the vast majority of our time just building the business and building value, increasing the size of that pie, we all do well. And I think like, maybe that's like a summary too. Like the bad investors that I see really are focused on the edge cases, the nickel and diming, the like optimizing of a few pennies here and there versus like the big thing that matters is taking $100 million value business to $1 billion. Like that's what matters. It doesn't matter, on the edges. And that doesn't mean that we don't have our attention to detail and we're not like, trying to do everything well. But in venture, you get paid by the outlier winners and how big they are. So like, let's focus on that.
And I think like that's important to focus on, Natty, because if you are a good VC and you have that team play mindset, then entrepreneurs sometimes don't even realize how much of an asset that is in the sense of protecting you in future rounds against predatory VCs. And I find that that's one of the things that like a second time or third time entrepreneur understands that is immensely valuable because, I would spend a lot of my time on different boards kind of having the side conversation with the other VC, like that's not how we're going to do things.
Right.
And I'm sure
on behalf of the entrepreneur,
on behalf of the entrepreneur and yourself,
like you were probably aligned in like in that scenario, you realized that the best way for you to improve your returns was actually the strategy that made most sense to the entrepreneur.
Right.
But the investors were trying to optimize for something else.
Right. Right. And I think it's a huge value add. I mean, I'm a big fan of yours. I've seen your work and I know that you're always there for the entrepreneur. And I think that often even first-time founders don't realize how valuable that is. Because the truth is, there's a famous saying, you name the price, I'll name the terms. And there's like 50 ways that you could sell a company for $100 million and own 50% of it and get like a $5 million check.
Right.
And as an entrepreneur, you really don't have time to worry about that all the time. And it's such a benefit to have a VC in your corner that is worried about that for you and is looking out for you and ultimately themselves as well, but really for you. It's invaluable.
Is, at the end of the day, the entrepreneurs are creating the value, right? So we want to give them every possible resource and give them the best chance of building a multi-billion-dollar company. And I think if we, VCs, like we just spend a lot of time, like, I see some patterns of like not really focusing on that. Like that's what matters, right? Like, can we build $1 billion company? If we build that, we're all going to do great.
Right. Right.
I mean, I know it sounds simple. There's a lot of work obviously that goes into that, but yeah, I mean, that's my answer to the question is like, I think the bad VC behavior is sort of like not focusing on the prize and really like not creating simple structures that create the most alignment with the entrepreneurs and really getting out of their way and looking at yourself as like, you're not a headwind for them. You need to be a tailwind for the entrepreneur, open doors for them, unlock opportunity, make good introductions, get out of the way when it makes sense, trust them, and let's go build a big business.
Yeah, they're already doing the hardest thing in the world to do.
Why do they need extra friction?
Right. Yeah. Exactly.
Thank you for coming on the show, Natty. This was
I have
awesome.
one thing that I think we didn't cover, which might be important for.
Let's do it. Hey, let's keep going.
Okay.
Yeah.
Well, up to you guys. One thing we could talk about is like, what are the terms on a VC fund? Like, is that something that you think?
Oh, absolutely.
Yeah, the fees, all that.
Like, yeah.
I mean, I think because I think there's some unique stuff. I don't know other asset. Like I know this asset class super well. Like I'm obsessed with it. I've been doing it for 7 years. I'm gonna do it for the next 20. Honestly, like I listen to your show because I need to learn about other asset classes because I'm just like so immensely steeped in this one. But what I do know is that the sort of structure of VC funds, I think, is a little bit different from other asset classes. So I'll throw it out there. You guys can then analyze it and compare it to other ones. But I think it's important for LPs to know is sort of the standard deal is that you commit to a venture fund, this 10-year vehicle. We talked about earlier, committing a certain amount of capital that's called over 4 years. What's nice about it being called over 4-ish years is usually people can commit a larger amount than they could literally write a check for that day because they're going to spread it out over 4 years. So I usually talk with LPs and make sure they understand that because sometimes there are minimums to join funds that are higher than an LP would feel comfortable writing a full check for. But if you think about breaking that over 4 years, sometimes that makes it easier. The second thing is sort of like how do we get paid? And so the typical terms on a VC fund are 2 and 20. And so what that means is there's a management fee of 2% of the total committed capital per year that pays for the managers to run the fund, the team, legal, operations, et cetera. And then the GPs earn 20% of the returns after 100% of the capital has been returned. And so they share 20% of the upside. So let's say you run a $10 million fund and you generate $20 million of returns. The first 10 million goes back to the investors. Then there's $10 million in gains. 2 million goes back to the GPs to be split however, their staff is. And 8 million goes back to the limited partners.
So let's do some LP math. Put 100,000 into your fund. I'm going to pay $2,000 a year in fees to keep the lights on, allow the team to go find deal flow, basically do things that add the value, build the value of my investment, work with the portfolio companies. Then as exits start occurring over time, once I get back $100,000, every dollar that comes back, that's pure profit. So it's past what I invested, past 100,000. It's going to be 20 cents for every dollar. That's how the GPs basically make their money.
Yep.
Yeah, and to be clear, because I know this industry super well, is that the 2% management fee is also not just like, the GP's making a bunch of extra money every year, and it's like talk through all the
it doesn't go very far.
Talk about all the expenses that you need to cover, and I imagine some of the GP carry that you're taking as a success fee still probably covers what you pay in management. So maybe go into that.
Yeah, I mean, it depends on the fund size. So, these bigger later stage funds, or even like multi-stage funds that have $1 billion of AUM, like the 2% on that is a lot of money. And those folks, I think, are making a lot of money. I'm not anti that model, but I think like the incentives are a little bit different than a smaller fund like mine, which I'll tell you about, because there is so much fee income coming into those big funds. But you'll see those big funds have much bigger staffs. Like they might have 100 staff members, 20 investing partners, 20, I don't know. I don't even know what they would, but like legal, ops, accounting,
offices,
brand, like, marketing, like, you could have a whole staff, and that's kind of on the other side for a smaller fund. So our fund is $53 million, our current fund. The 2% doesn't go very far. We have a staff that we have to pay. We have a bunch of operating expenses. We have legal expenses. We have accounting. We have tax. We have our salaries. So, like I'm fine. I don't need much. I'm very incentivized by the carry. That's my big, golden ticket there. But, the money for smaller emerging managers or smaller funds, like the fees you're not getting rich on the fees. But I think that's good because, that aligns incentives. Like my opportunity to do super well is when the LPs do really well, which is like we go out and we find the next, Stripe, the next Facebook, the next OpenAI, the next whatever it is. Like we're going to make a lot of money, but so are you. And I think those incentives are nicely aligned, at least on the smaller fund side of things.
Well, and there's a lot of data that supports that, right? Is that, if you run $1 billion fund, you can sit back and get rich and the fund really not do very well. You really don't return.
And it's hard to return those funds, like to double.
Totally.
Like I think these $1 billion funds do well if they maybe double.
Right.
Like my expectations are much higher than that. And I think the reality is I can do better than that because it's easier to grow a smaller pot of money than it is to, double $1 billion fund.
Yeah, Warren Buffett's talked about that.
And also you have to do better to get paid.
Totally.
So the incentive is there, like you said.
Well, this is something like I also encourage LPs is to like when you meet managers that you might invest in, like what is their level of hustle? Like, I've done okay. I had a startup that like had a modest exit. I bought a house in Boulder. Like I'm comfortable, but I have not made it. And I think like what you want to do is you want to back the GPs who are hustling and have something to prove and, have their reputation on the line, which is like what we do. I mean, I basically spent 15 years building a reputation to be able to do this fund. Like my reputation is on the line.
Right.
I'm going to work damn hard to like make this successful because the upside is there for me if I do well, but also my reputation's on the line. And I think I think sometimes people think of like, oh, ventures like an easy business or like, I don't know, people are kind of like sitting back and getting rich. And like, yeah, some people are, but there's also this whole cohort of emerging managers that are working their ass off and have a lot to prove and are like all in on it. And, that's the type of entrepreneur we want to back. And I also think that's the kind of GP you want to back if you're looking for a fund to invest in.
So something I'd love you to maybe give your MBA example, and for you to maybe work off of that. But the question to both of you here is, some LPs come and think about like, wow, I'm giving away 20% of the upside. I put all the capital in. What gives, right? Like, how does that make sense? That feels like 2 and 20 feels like a pretty big fee. How do you rebuttal?
Did you want to answer it? I'm happy to if you want.
We could both answer.
Yeah.
Look, the truth is you're giving up 20% of profit only. So it's like a commission model. And their profits you wouldn't have realized otherwise. So it's, when you think about the amount of work, usually I find that people that have that opinion don't realize the scope of the work, which is why we on the show really talk about what it takes to do it professionally. And if you had anybody do that amount of work for something, they might think 20% is too little. So I actually think it's a very reasonable structure, especially because it's of the profits, not of the principal.
Yeah, I agree. I think the other thing that is unique is like in other asset classes, the GP can get rich quickly. I guess it can happen in venture too, because sometimes you have these like rapid successes. But the majority of the people that I know in venture, like it takes a long time to make your money. And so what you're kind of like, you have someone who's working on your behalf for 10 plus years. If you run a hedge fund and you have a really good year, you can cash out and be done. And it's all of a sudden, and like, yeah, cool. I mean, your investors made good money, but like you have a team that's dedicated to growing the value of your assets for a long period of time. I think at 2%, that's pretty reasonable. And then to your point, just sharing in like a commission structure, 20% of the upside, I think feels pretty fair for the, risk that GP is taking, in terms of, we don't have liquidity in that until you do. And so it's not like, there's sort of like a duration, cost or benefit that I think is sort of undervalued in venture. We talked about sort of like the duration and the fixed, illiquidity as a feature versus a bug. One other thing that people like about venture is it kind of rides across cycles, unlike other assets. So maybe real estate's kind of similar to this, but like, if you're in and out of public equities, like you're riding the cycles like crazy, right? You're trying to time the market, which is super hard. In venture, you're building a big company or you aren't. And so it tends to sort of even out across cycles, and people like that they have their money parked in a place that they actually like cannot move it around across cycles. And then, there's some luck certainly in venture. Well, there's a lot of luck in venture, but like luck in terms of like, when are you investing those dollars? Did that end up being like a good time from a cycle perspective? And when your companies are exiting, is that like a good IPO window, a good exit window or not? And, that's sort of out of your control, but at least you're kind of riding across the like, day to day, month to month gyrations of the markets.
Yeah, I find that illiquidity in venture is both a feature and a bug.
Yep.
Because it feels confining sometimes in the sense of I can't do anything with this capital. I'm along for the ride. But the truth is, like, if you talk to a lot of investors, even in the Ubers or the Googles or the big wins, if they had liquidity as an option, they never would have realized the big win.
Right. They would have sold it early.
They would have sold it. They would have gotten news that, because venture is constant ups and downs. It's, Microsoft called, they want to do a pilot. And if it was a liquid asset, the stock price would just skyrocket. And then, Microsoft canceled the pilot. Stock price like plummets. Right. And a lot of people would, people are very reactionary. They're very emotional in their investing. I think that's why it's really smart to use professionals like yourself. And then subsequently, I think that's where liquidity, studies have shown, right? The problem with most investors is they're overactive with their investments.
It's like, it's not timing the market, it's time in the market.
Right.
Right. And
exactly.
I think like venture forces you to have a lot of time in the market.
Right. You have to.
Right. It's like, yeah.
It's also why the diligence is so important, because you're basically getting married to this entrepreneur for 10 years. Yeah. There's no like easy off ramp or easy divorce. We can't just
be like, we don't like this entrepreneur.
Right. Right.
We're like out.
Yeah.
It's not an option.
Right.
Yeah. I also remember having a conversation with Jason Seitz when I worked at Techstars, who is the chief investment officer there. And I asked him about, we're heading into this kind of economy where, I think equity markets are starting to go down. And how does he think about investing? And there was this very interesting answer that he gave, which was like, look, the venture fund, it doesn't really matter to us if the market is up or the market is down. You might be able to get better valuations or something like that when you're investing, but people are still building businesses. And also, historically, we've seen some of the biggest businesses being built in times of recession, like Uber or Airbnb or things like that. And then also it's like you said, one of the features of doing capital calls over maybe a 4-year time span is that you're not investing, typically like if you're doing a syndication of a very specific real estate deal where you're buying one apartment building, you're buying that apartment building at this time. Whereas in venture, you're buying over, you're automatically getting
some vintage diversification,
right. Because you're investing X% every single year.
Well, this is something like that was, so we're coming out of like a crazy cycle in venture. So 2020, 2021 was sort of like outlandish, amount of capital deployed and valuations and terms. And thankfully that's corrected. And I think that it's a much healthier ecosystem now. But one of the problems you had was over that cycle, venture funds started deploying their capital much faster. So instead of a typical 3 to 4 year deployment period, funds were deploying their capital in 1 to 2 years. And the problem is you lost vintage diversity. And by that, we mean, the 2018 batch of companies sort of is going to have some characteristics, the 2019 batch of companies, the 2020, 2021. And across a fund, you actually want that diversity, both in terms of like the macro trends that you're investing into, the price of those startups, a lot of stuff like that. And so it's actually like good to have a fund deployed over 3 to 4 years, but you saw this compression of that over the last few years. And that I think is going to, like a bunch of those funds are going to underperform because they ended up deploying a ton of capital at the peak of the market versus a fund that maybe was more disciplined and invested over a longer time frame, maybe put some investments in at the peak, but is also going to have a bunch of investments sort of in this like, more sane era. So it really matters. It really matters.
Well, cool. Yeah. Anything you think we missed that you think is still relevant for LPs?
I'm sure we missed a lot.
I'm sure we did miss a lot, but
you're only a short drive away.
Yeah.
Thank you guys.
Yeah, no, thank you for coming on the show, Natty. Thank you for sharing everything, and talk soon.
Yeah.
Thank you.
All right.